Hi, I just wanted to give a explanation for essential question number one, and this is the second shot you guys have had at it in the spring of 2012. Remember, all these are very simplified examples, and we are essentially focusing on the first part of the transaction and not waiting for it to flow over all the sheets. So it may seem a little bit weird, but we have this barrier that's in between the income statement and the balance sheet, just to, again, make things a little bit easier. So let's start with the first question, which we'll go ahead and handle in red. You are the CEO of a robotics manufacturing company. An investment company offers the company cash in return for 10% ownership, and you accept. Well, this is the one where you're getting someone who's a new owner. So you end up with a bunch of cash, which is what they offered you, and at the same time you're going to have this increase in owner equity. Now please note that that balance sheet balances. That's one of the key points we have to have here. So it either means if you see an increase in assets, you're going to see a decrease in a different kind of asset, or you're going to see an increase in some combination of liabilities and owner equity. Now the other thing that needs to go on here is that that change that took place on the balance sheet gets echoed someplace else. And where this gets echoed is going to be in finance. Now the thing to note is that you ended up with more cash, and so increases in cash look like a positive item on the cash flow statement. Inflows look like positive numbers, outflows look like negative numbers, and when you have changes in owner equity, it's reflected in the finance section. So that should get us through question number one. So let's go ahead and take a look at question number two in orange. To increase brand awareness, you spend cash reserves on a new marketing campaign. Well, this hasn't generated itself any sales yet, so all what we're looking at here is an increase in expenses. Remember, the convention is that if it's a positive number is kind of like the normal direction, you have an increase in the normal direction. So this should back up your kind of instinct to start looking at it in terms of how does it affect net income originally or immediately. And in fact, what you're doing here is checking to see that you understand the sign convention, because in the end this results in a decrease in net income, and because net income feeds into cash from operations, there's a decrease in cash from operations. Easy enough. So let's go ahead and move to the next question, which we'll go ahead and mark up in yellow. As a result of your new marketing campaign, robot sales increase. Okay, so remember, this one is going to cause a couple of different things to happen to you, so we're going to have some indeterminacies. So the first thing you say is, okay, so we know revenue is going up. Perfect. But at the same time, you know that there are always some expenses that are associated with increasing revenue, so you're probably going to see this increase in operating expenses at the same time. Now, what does this mean for net income? You know what? It's indeterminable at this point without knowing the scale of each. So let's just go ahead and say it could go either way. We don't know for sure. And that means that the effect on cash from operations could go either way. We don't know for sure. So again, this is one of those questions that does have some indeterminacies in it, and we'll kind of give you credit for both, or wish we could give you more for the noting the indeterminacy, but this is something which is pass and no pass. Switching to green, to accommodate increased sales, you hired 10 new workers. Workers, although we usually say that you're an asset to the company, what's really going on here is you've got yourself an increase in expenses. These are people that you pay every month. It's a flow, and that's one of the key things to identifying what's on an income statement rather on a balance sheet. If you're looking at so much per month, it's on the income statement. If you're looking for something which is measurable immediately at that particular point in time, you're looking at something that's on the balance sheet. So if you've got an increase in expenses, that results in a decrease in net income, and that will result in a decrease in cash from operations. That's the end result of question number 4. So let's go ahead and switch to blue for question number 5. Due to a new government contract, you open a manufacturing plant by taking out a loan. This is the simple kind of loan question that we deal with. So what you're seeing is that an increase in cash that's there. That's what comes in from the loan, and it's balanced off by this increase in liabilities. Remember that liabilities plus owner equity has to equal assets, and that's what we did. We balanced this little guy out. But things on the balance sheet tend to have echoes over into the cash flow statement. In this case, what we're seeing is taking out a loan. This is financing activities. And so we've got a decrease in cash, an increase in cash from finance right there. And that should finish off question number 5. So let's go ahead and switch to, what do you call that, light blue, blue-green. Due to a patent dispute, you make a deal to purchase patents from a rival manufacturer using cash. Okay, so we're dealing with a basically getting rid of some cash. So there's a decrease over there. And you're getting another kind of asset. Intellectual property is usually a other asset. And it's going to be something which is we don't stick it into the fixed, we don't stick it in the current. So what you're seeing here is a balancing out of the balance sheet solely in the asset component of it. So you're switching an asset for another kind of asset. And at the same time, what you're dealing here is purchase and sales of asset. This is what goes on in an investment. Note that although it was an increase in investments, what you saw was a decrease in cash because you were investing. And so you'd see this as a decrease in cash investing activities over on the cash flow statement. And that's got the connection again between the balance sheet and the cash flow statement. So let's switch to another color again, and I think this one is purple. Yeah, there we go, it's purple. You make a payment on a previous zero interest loan. And please note that the zero interest part is there just to make it nice and easy. It means that nothing shows up in the income statement, because when you make a payment, the only thing that shows up on the income statements are supposed to be interest. Everything else is a balance sheet or cash flow item. So what we have here is a decrease in cash because you're making a payment, and at the same time you're decreasing the scale of liability that you have. That balances itself out, and when you make the payment, it's part of a financing activity, so you'll have a decrease in cash from finance. Easy enough, and that's like the classic pattern. Things get more complicated once you start adding in interest, because then you've got an interest expense over here, which results in a decrease in net income. So you also have a resulting decrease in cash from operations because of that. So it's a little bit more complicated when there's interest. That's why we give you this simplifying assumption. And then the final question we'll go ahead and handle in black right here. And this one is you sell old manufacturing equipment for cash. And again, what we're looking at here is a decrease in some old fixed assets that you had, which results in an increase in some current assets. That's cash. And remember, watch the cash. You had an increase in cash, and what you have is an increase in cash from investment. So it's kind of like the opposite of what you had in question number 6. So that should go ahead and give you a short explanation of essential question number 1, your second shot at it in the spring of 2012. Thank you.